Right now, most people think the crypto market is quiet. Prices are moving slowly, volumes look weak, and retail investors are either bored or scared. But beneath the surface, something very different is happening. Smart money is quietly accumulating crypto, while most people are still waiting. And by the time this becomes obvious on Twitter, by the time YouTube turns bullish, the opportunity will already be gone. Most crypto investors make the same mistake every single cycle. They wait for excitement. They wait for confirmation. They wait until prices start moving fast. They believe that quiet markets are dangerous, when in reality, quiet markets are where smart money is built. Retail investors buy when emotions are high. Smart investors buy when emotions are dead. This is why most people enter crypto at the worst possible time and exit right before the real move begins. In this video, I'll show you which types of crypto assets smart money is accumulating right now and why. We'll break this down using on-chain behavior, market structure, liquidity zones, and historical patterns from previous cycles. This is not about hype coins. This is about where patient capital positions itself before momentum returns. And if you want data-driven crypto insights instead of emotional noise, make sure you're subscribed. This channel is built for smart investors. What smart money really means. Before we talk about accumulation, we need clarity. Smart money doesn't mean insiders with secret information. It means investors who think in cycles, not weeks, focus on risk-adjusted returns, accumulate during boredom, distribute during euphoria. Smart money is patient capital, and patience is the rarest skill in crypto. Or principle. Accumulation happens when attention is low. Every major crypto cycle has the same structure. Fear, boredom, disbelief, expansion, euphoria. Retail shows up during expansion. Smart money shows up during boredom. Right now, attention is low. Search trends are quiet. Retail interest is minimal. Historically, this is exactly when long-term positions are built. Most people don't notice this. By the time price looks safe, the risk is already highest. Bitcoin, foundational accumulation. Smart money always starts with Bitcoin. Bitcoin is not about fast gains. It's about asymmetric upside with decreasing long-term risk. On-chain data consistently shows large holders accumulating during low volatility periods, sideways ranges, negative sentiment. Institutions use Bitcoin as the base layer of exposure. It's liquid, it's resilient, and it leads the market. When Bitcoin is accumulated quietly, it usually precedes broader market strength. Ethereum. Ethereum is treated differently from other altcoins. Smart money sees it as infrastructure, not speculation. Accumulation happens when network usage remains stable, fees normalize, price underperforms narratives. Institutions don't chase ETH when it's trending. They build positions when sentiment is neutral. Ethereum often lags Bitcoin during accumulation, then accelerates once confidence returns. Scaling and infrastructure projects beyond Bitcoin and Ethereum. Smart money targets infrastructure that benefits from long-term adoption. These projects are not chosen because they will pump tomorrow. They're chosen because they become more valuable as the ecosystem grows. Accumulation here is slow, methodical, and patient. Smart money doesn't need instant validation. They need structural relevance. This is where retail usually gets trapped. They wait for price to move first. Smart money waits for value to appear. Data, oracles, and backbone tokens. Another area smart money quietly accumulates is data-related infrastructure. These assets don't create hype. They enable functionality. Historically, these types of tokens move late in cycles, attract institutional capital, outperform once liquidity returns. They are ignored during boredom and chased during expansion. Smart money prefers to be early. Liquidity and financial primitives. Smart investors understand something retail doesn't. Liquidity always wins. Projects that facilitate trading, settlement, or liquidity flow become more valuable as markets heat up. Accumulation here happens before volatility expands, not after. These assets benefit directly from increased activity. not just speculation. Why smart money avoids most hype coins. One of the biggest differences between smart money and retail is what they don't buy. They avoid low liquidity, weak tokenomics, purely narrative-driven pumps. Smart money is allergic to crowded trades. If everyone is bullish, risk is already elevated. This discipline protects capital, even when opportunities are missed. Risk management during accumulation. Smart money never assumes they're right immediately. Accumulation is done in stages. Capital is deployed slowly. Invalidation levels are respected. If the thesis breaks, positions are reduced. If structure holds, exposure increases. Retail goes all in emotionally. Smart money scales rationally. Here's the part most people don't understand. Accumulation feels uncomfortable by design. Why accumulation feels boring. If accumulation felt exciting, everyone would do it. Prices move sideways. Nothing happens for weeks. Doubt creeps in. This psychological pressure forces weak hands out and allows patient capital to build quietly. Boredom is the cost of asymmetric opportunity. When accumulation turns into expansion, accumulation ends when volatility returns. Narratives reappear. Retail interest increases. At that point, smart money stops buying and starts managing exits. Retail enters with excitement. Smart money prepares distribution. This cycle repeats every time. Nothing is guaranteed. Markets can stay range-bound longer than expected. Bitcoin still controls direction. If macro conditions shift negatively, even strong accumulation zones can fail. That's why smart money prioritizes survival over predictions. Smart money doesn't chase pumps. They don't react to headlines. They don't buy excitement. They accumulate quietly when no one is watching. And let time do the work. If you want to position yourself ahead of the crowd, stop asking what's trending today. Start asking, where is patient capital positioning before the next move? If this video helped sharpen your perspective, subscribe for more data-driven crypto insights. And I'll see you in the next one.